Good morning, students. Today we will be doing the revision on Ind AS 102, that is share-based payments, a very important standard from your examination perspective. You can expect 6 to 8 marks on an average regularly coming in your examinations and a highly scoring topic as well. Okay, what I will do is I will be taking you through with the help of this sheet which is already shared with you. A lot of things, all the problems are covered here, and the theory as the class progresses, we will be discussing. Since this is a revisionary lecture, I presume you already would have gone through the actual topic, the recording, and this can refresh whatever you have studied there. Okay, so we take up from here, from there. All right. Now, when we talk about share-based payment, why do we name this standard as share-based payment, or rather, what exactly gets covered in this standard? So basically, when an entity may agree to pay for the goods or services it receives in the form of its own shares. So a party supplies goods or services to the company. The company makes the payment in the form of its own equity shares, in which case it is known as an equity settled transaction, or it makes payment in cash, but the value of the cash that it pays is determined basis the value of its own shares. So in the first instance, it makes the payment in its own equity shares. In the second instance, it makes payment in cash, but the value of the cash that it pays to the party for who has supplied the goods or services, that value is determined basis the value of the company's own equity shares. So either it is issue of shares or issue of cash. Examples is your ESOPs, where the transactions get settled in own equity shares. And your cash settled plan, best example is share appreciation rights, what we call as SARS, SARS. Okay, share appreciation rights, in which case transactions are settled in cash, but based on the entity's own share price. So, what is the distinction between an ESOP and a SAR as far as accounting is concerned? Well, when you account for an ESOP, you will have an SBP reserve, a share-based payment reserve that gets created for every amount that you recognize as an employee benefit expense towards the ESOP that you are accounting for. And you measure it using the fair value at the grant date. There is no subsequent revaluation that happens. That is as far as ESOP is concerned. What about SAR? In case of SAR, for every employee benefit expense that you recognize in respect of this stock appreciation, right, you will be crediting the corresponding amount to an SBP liability. Why liability? Because this is an obligation to deliver cash. So you will credit SBP liability. And do I have to revalue? Answer is yes. Because this is a liability, it has to be fair valued. So at every reporting date, there will be a fair valuation that is done at the reporting date. All right. So this is broadly the main difference between an ESOP and a SAR. So when we talk about, and in this entire chapter, the most important part is employees share-based payments. That is the substantial part of the chapter. We have a couple of small provisions or a couple of small topics that do deal with uh, share-based payments other than employees. We'll cover that also, but that is largely ornamental in nature. The main heart of the standard lies in employees' share-based payments. We did have this as part of the guidance note in your intercia, guidance note on share-based payments. So that being a guidance note was recommendatory primarily. But this being an accounting standard, Ind AS 102 becomes mandatory to follow. So when we talk about employees' share-based payments, now the next couple of hours, we will be discussing largely on employee share-based payments. So in terms of your share-based payments, we have a couple of terms which are used frequently. Like, for example, the first one is your grant date. What do you mean by grant date? It refers to the date when all the terms are finalized, approvals are received, and the share-based payment plan is communicated to the employees. So you have to finalize all the terms, receive all approvals, including shareholders' approvals wherever required, and the share-based payment plan is communicated to the employees accordingly. That becomes your grant date when you grant the options. Then there comes something known as vesting period. Vesting period is basically entitlement. Vesting is basically an entitlement. That means I actually become entitled to the options as an employee. It refers to entitlement. Vesting period, it refers to the number of years that an employee needs to serve in order to become entitled to the options. So vesting, become entitled. Vesting period, the time required to become entitled to the option. If an employee leaves during the vesting period, he will not be entitled to the options. He will not be entitled to the options. Then you have exercise period. Exercise period follows the vesting period. So vesting is over, then you can exercise, wherein you exercise the options and get the shares of the company. An employee can exercise during this period only. And what is important to note is an employee who completed the vesting period and left the organization, that employee also can exercise the options during this period. So options, once they vest, once the employee becomes entitled to the options, he will continue to remain entitled even if he leaves the organization during the uh, exercise period. So that is the next. Then you have fair value. What is fair value? This is the value of the option. In your examination, you will always be given the fair value. It is a forward-looking value. It is a forward-looking value, typically calculated using option pricing models like Black and Scholes model or binomial model. Whatever be the scenario, you will use that to arrive at the fair value, and that becomes the basis for accounting for your employees' stock option plans. Okay. Intrinsic value is current value, which is basically current market price minus exercise price. You used to do the accounting as per intrinsic value under the guidance note. But the problem with intrinsic value is that it is based on current market price. Vest. If the shares vest immediately, then you recognize the expense also immediately. It is like a compensation that you are giving for the past service that he or she has provided. When you talk about vesting period, when your stock options vest over a period, then you recognize expense over that period. You recognize the employee benefit expense over that period. Measurement would always be at fair value at the grant date for ESOPs. For SARs, fair value at each balance sheet date, you will do a restatement. Okay. So with that, let us try to understand some of these concepts using the questions. Okay. So Good Luck Limited grants 180 share options to each of its 690 employees. Okay. Each grant containing condition on the employees working for Good Luck Limited over the next 4 years. So what is this working over the next 4 years mean? This means that you have to remain in the organization for 4 years, after which you can exercise. But in these 4 years, it will vest. So therefore, can I say that the vesting period is 4 years? Yes or no? Yes. Good Luck has estimated that fair value of the option is 15. That is also given to you. Good luck also estimated that 30% of employees will leave during the 4-year period and hence forfeit their rights to the share options. Forfeit their rights to the share options. If the above expectations are correct, what amount of expenses to be recognized during the vesting period? Okay. So first one. How many options are there? 690 into 180, 124, 200. Out this 30% employees expected to leave. So you are accounting for those options which are realistically expected to vest. And that is always the scenario, 86,940. Then fair value per option given 15. So fair value of options expected to vest at the end of the vesting period. So that is 13,04,100. Amount expected to vest in year 1 is basically the whole amount divided by 4 years. So 13,04,100 divided by 4. Every year you will book an expense of 3,26,025. Are we okay with this? Yes. Are we okay? Any doubts? No doubts? All right. Fine. Next. Coming to the next one. ABC Limited granted to its employees share options with a fair value of 5 lakhs. So already they have given the fair value. Okay, that means this is already given fair value of options. Okay, if they remain in the organization up to 31st March X3, that means 1, 2, 3. That means you have a vesting period of 3 years. On 31st March X1, ABC expects only 91% of employees to remain in employment. So as I said, this is a judgment that is taken, an estimate that is made as to who are the employees who will remain in service till the end of the vesting period. You can always say, how do you know? But there are some realistic attrition rate analysis that you have, some visibility that you have. So basis that you try to arrive at a reliable estimate. On 31st March 20X2, company expects only 89% to remain in employment. Can estimates change? Yes. As facts change, estimates also undergo an updation. However, only 82% remained in the organization at the end of 20X3 and all of them exercised their option. Task the journal entries. Okay. So you start off with 91%, then you see that 89% will be there and then 82%. Can this change? Answer is yes. This is a change in accounting estimate, which is absolutely normal under your Ind AS, which is absolutely normal under your Ind AS. Okay. So that becomes your understanding. So I have percentage of employees 91, 89, 82. Total value of options expected to vest 5 lakh into 91%, 455, 445, 4 lakh 10,000. Okay. Now, this is over a 3-year tenure. So if it was there for entire tenure, you had 91%, your total expense would be 4,55,000. But this is only 1 year. So it will be into 1 by 3. In the second scenario, 4 lakh 45,000 is basically your expense. And this is to be borne in the ratio of 2 by 3. Yes, 2 by 3. That is, what do I say? 3 years life and 2 years vesting, 2 years for the current period. Okay. So proportionate cost for the year 2,96,000, out of which 151 is already booked. So you will be having 1,45,000 only. Are we okay with this? Yes. Are we okay? No doubts? All right, fine. Next one. Next one. Here you have a correct picture. 82% actually vested. So you should have booked an expense of 4,10,000. out of which you have booked 2,96,000. So last year your hit to the P&L is 1,13,333. Okay. So if you look at the journal entries, every year you will pass an entry, employee benefit expense account debit to SBP reserve equity, 1,57,000. Sorry, 1,51,000, 2,97,000, and 4,10,000. Are we okay with this? Yes. So this one, this one, this one. And then after that, 82% remained in the organization and all of them exercised the option. So when they exercise the option, what is the entry that is posted? SBP reserve account debit to equity share capital. Yes, SBP reserve account debit to equity share capital, 4,10,000. Are we okay with this? Yes. All right, fine. So that takes care of this question and this question. Next, go through this question. Yes, an entity issued 100 shares each to its 1,000 employees, subject to a service condition of the next 2 years. Grant date fair value is rupees 195 each. There is an expectation 97% of employees will remain in service at the end of first year. However, at the end of second year, the expected employees to remain in service would be 91% of the total employees. Calculate the expense for years 1 and 2. So just go through this right now. Take 2 minutes. Yes. Take 2 minutes. Go through this. Okay. So that is easy enough, I hope. Okay. So nothing new. Exactly what we did in the previous question. Okay. Now we move on to the next one. The following particulars in respect of stock options granted by a company are available. Want me to zoom it? Is it visible now, Manish? Yes. Okay, fine. All right. The following particulars in respect of stock options granted by a company are available. Number of employees covered 525, options per employee 100, vesting condition continuous employment for 3 years. Nominal value, that is face value 100, exercise price 125, fair value of options on grant date is 30, exercise period is 1 year, vesting period is 3 years. So your option life is 3 plus 1, that is 4 years. Okay, so position at the end of year 1, estimated annual rate of departure 2%, number of employees actually left is 15. Estimated annual rate is 3% at the end of year 2. Number of employees left is 10. At the end of year 3, number of employees left is 8. Number of employees expected to entitled to exercise the option 492. Number of employees exercising the option 480. Number of employees not exercising the option equals 12. Compute the expense to be booked each year. Show the journal entries and ledger accounts. Okay, fine. So now let us start. So at the end of year one, you started off with 525. At the end of year one, you have 510 employees. Yes, you have 510. Annual forfeiture 2%. So it will be 510 into 100 shares into 98% into 98%. That comes to 48,980. Yes. So 48,980 is the number of options expected to vest. So this you will multiply it by 30. 1469 400. 1469 400. Proportion of expenditure is one third. So first year expenses 489 800. So 489 800 becomes your first year expense. Are we okay with this? Yes, Manish, any doubts? Because see, end of year one, year two, year three, year one, year two, year three. See, at the end of year one, I have 510 employees, 525 minus 15 who left. Now, my estimate is I will lose 2% here, the employees will leave, and I will lose another 2% here. So, therefore, 98% and then 98%. Okay, so that comes to 98% twice. Any other doubts, Shashika, Manish? Yes. You can feel free to unmute and speak. Okay, there is no challenge. It's just you. All right. So 489, 800. Now, at the end of year two, a further 10 employees left. So I had 510 minus 10, 500. And you are expecting annual rate of departure of 3%. So only 1 year is left. That is third year. So therefore, it will come as 1. So 500 into 100 shares into 97%, 48,500. So total value 14 lakh 55, two third, 9 lakh 70,000. What is recognized? 489 800, 4 lakh 80,200 is what is your expense to be recognized in the current year. Any doubts? Any doubts in this? Yes, Manish. Now, moving to the last year, number of employees left is 8. So 500 minus 8, 492. Now, no question of forfeiture. This is the last. So 492 into 100, 49,200. So 14 lakh 76,000 is your total expenditure, out of which you have booked 9 lakh 70. Therefore, last year you will recognize 5 lakh 6,000. Last year we will recognize 5 lakh 6,000. Is it okay? Yes, fine. Okay, some of the so this is one way of solving. Some of the solutions you can see that number of employees are rounded off first. So what they do is it is 510 employees into 98% into 98% comes to 489.80 employees. That is basically 490 employees into 100. So 49,000 shares. This is also a reasonable assumption that is made. Okay, so nothing wrong here. You can take 48,980 or 49,000. Small variation will be there, but you can put this as a note and continue. Okay, so now when you talk about the ledger entries, first one, employee benefit or employee compensation expense account debit to SBP reserve. It is going to be 489 800, 480 200, 5 lakh 6,000. Are we okay with this? And that will be transferred to the P&L. Any doubts here so far? No doubts. Okay, fine. Coming to SBP reserve, this is the opposite. by employee compensation. So 489, 489, 480, 200, and then 5 lakh 6,000. So this becomes your third year accounting. Coming to the next one. Coming to the next one. Now, year 4. What is year 4? Is it a vesting year or is it an exercise year? Just a minute. All right. Yeah. So year 4 becomes your exercise year. So now you will exercise the options. Now, what does the question say? Out of 492 employees, 480 employees exercised the option. Exercise price per share is 125. And number of employees not exercising the option is 12. So obviously that will lapse. So when you talk about exercise, now I have 14,76,000 balance in your SBP reserve, which is basically 49,200 options into 30. So this much is the balance in your SBP reserve. Now 480 employees have exercised the options. So what is the entry that will be passed? The entry that will be passed first is bank account debit 48,000 shares, 480 into 100 into 125, 60 lakhs. For the time being, you park it in SBP reserve 60 lakhs, being amount received in respect of 48,000 shares at 125 per share. This is the first entry. So by bank 60 lakhs. Is this okay? Up till now, is this okay? Yes. Manish, is this fine? Yes. Now, you have given 48,000 shares. So 48,000 into 100, 48 lakhs will be credited to your share capital account. 48,000 will be credited to your share capital account. Now, when I look at my SBP reserve has 30 rupees, which was the fair value at the grant date, plus 125 rupees exercise price. Yes or no? Plus 125 rupees exercise price. So SBP reserve 48,000 into 155 per share, 74 lakh 40,000 debit, because now SBP reserve is getting utilized. Yes or no? So 74 lakh 40,000. And securities premium will be the balancing figure of 55 rupees per share. 48,000 into 55, 26 lakh 40,000. Are we okay with this? Yes, Manish, did you follow? Manish, any doubts beta here? No doubts? Shall we proceed further? Yes. All right, fine. So 48 lakhs debit, 26 lakh 40,000 debit. Then you had 12 employees who did not exercise the options. So 12 employees means 12 into 100, 1,200 shares into 30 per share. This is forfeited. That means it will be transferred to retained earnings. So SBP reserve 36,000 to retained earnings 36,000. So to retained earnings 36,000. So your total SBP reserve account stands tallied. There won't be any balance, which is the right way to understand, because the moment your stock option plan ends, that means you have lived through the life of the stock option plan. You cannot have an SBP reserve after the ESOP plan ends. Ends means vesting is over, exercise also over. After these two are over, you cannot continue to hold balance in the SBP reserve account. Are we able to understand this? Yes. So this is how the securities premium was calculated. Okay. Exercise price 125, 30 is value of service, total consideration 155, 100 is nominal value, so 55 becomes your securities premium per share. Are we okay with this? Yes. Are we okay? Yes. Manish, bolo. Yes. No response. All right, fine. Let's move. I hope you understood. Yes, all good. Now, okay, fine. We'll proceed further. Now, I'll cover up employee share-based payments again as part of subsequent discussions. Okay. Before that, couple of small pointers. Yes. What about share-based payments for goods and services other than employees? Other than employee. So there are two aspects to this. The first one is timing. When are you going to record? The second one is measurement. At what value are you going to record? So when you talk about timing, in the case of goods, I will record when I receive control of the goods. In the case of services, as and when service is rendered, I will recognize the employee benefit expenses. Okay. Measurement, this would be at the fair value of goods or services received, generally presumed to be available. If fair value is not available of the goods or services, then you will look at fair value of options issued. You will take it at fair value of shares or options issued. Are we okay with this? Yes. So that's simple. No doubts in that. Yes. Next. We then come on to an interesting scenario known as group share-based payment plans. Group share-based payment plans. Here what happens is that in a group share-based payment plan, parent will issue shares in the share-based payment plan of S, or subsidiary will issue shares in the share-based payment plan of parent. Okay. Let us take an example. Let us take an example. Suppose you have a company called Reliance Retail. Okay. Reliance Retail is a subsidiary of Reliance, is a subsidiary of Reliance. Now, the employees of the subsidiary, that is Reliance Retail, are given a stock option plan. They will say, you are giving me stock options of a company which is not traded in the market itself. If they say, if company says, I'll give you shares of Reliance Retail, then employees will say, where do I sell it? Because it is not listed. So employees will naturally have the question, where can they sell it? And the answer to that question is Reliance Retail will say, okay, I will not issue my shares to you. I will tell Reliance Industries to issue its shares to you for the services rendered to me. So, services are given by employee of the subsidiary to the subsidiary. In lieu of this in lieu of this arrangement, the parent is issuing shares to the employees of the subsidiary. So what is the journal entry that will be passed? Can parent debit employee benefit expense? Answer is no, because employees are not benefited. Employees of P are not benefited. But for S, can it be expensed? Answer is yes, very much, and it should. Employee benefit expense account debit. So that is in the books of subsidiary. In the books of subsidiary, what can I credit? Can I credit equity? Answer is no. Yes. So therefore, in the books of subsidiary, you will pass the entry employee benefit expense account debit to capital contribution from parent. To capital contribution from parent. Are we okay with this? Yes. Are we okay? Yes. Okay. Next. If subsidiary posts this entry, then parent will pass the entry as investment in subsidiary account debit to SBP reserve. Investment in subsidiary account debit to SBP reserve. Because an SBP reserve is created in the books of the parent. Whereas in the books of the subsidiary, capital contribution is from the parent. Capital contribution is from the parent. Are we okay with this? Yes. Are we okay? Next, if subsidiary issues shares in a share-based payment plan of the parent, then services are provided to the parent, employee benefit expense account debit. To what it is? Why will a subsidiary issue something helping the parent company? Well, that becomes kind of a distribution to its employees. So therefore, to dividend income, it will be credited as dividend income. Books of subsidiary, you will pass the entry dividend distributed account debit to SBP reserve. To SBP reserve. Are we okay with this? Yes, are we okay? Any doubts? No doubts? Yes. Subsidiary to parent is dividend. Try to make sense of what it is actually going to be. So we are following substance over form methodology of accounting. Methodology of accounting. Okay. Manish, is it clear? So we look at the entry. We look at a question. Company P is a holding company for B. A group share-based payment is being organized in which parent issues its own equity shares for employees of company B. The details are as below. Number of employees 100. Grant date fair value 87. Number of shares to each employee granted 25. Vesting conditions immediately. Vesting conditions immediately. So here you will pass the entry how much? 2500 into 10 and 87. So 87 minus 10, 77. So 25,192,500. Investment in company B 2,17,500. Are we okay with this? Yes. Yes. And then employee benefit expense in books of B debit. To capital contribution from P 2,17,500. Being issue of shares by parent to employees pursuant to group share-based payment plan. Yes. Any doubts? No doubt. Manish ji, we'll wait for a year before we proceed. All right, fine. Next. A parent grants 200 options to each of 100 employees of its subsidiary, conditional upon completion of 2 years service with the subsidiary. The fair value of the share options on grant date is rupees 30 each. At grant date, the subsidiary estimates that 80% of employees will complete the 2 year vesting period. This estimate does not change during the vesting period. At the end of the vesting period, 81 employees complete the required 2 years of service. The parent does not require the subsidiary to pay for the shares needed to settle the grant of share options. Pass necessary journal entries for giving effect to the above arrangement. Okay. So now 100 employees, each employee 200 options, 80%. So that gives you 200 into 100 into 80%. 4 lakh 80,000. Once I multiply by the uh, yes, 4 lakh 80. 1 by 2, so 2 lakh 40 is what will be recognized. Okay, next. 100 employees, 81% actually left. 81%, sorry, complete the required 2 years of service, 81%. Fair value, rupees 30, 486, 2 by 2, 486, 240, 246. Okay. So that gives you share-based payment arrangements in a group ecosystem. In a group ecosystem. Okay. Yes. Next one. Can you please go through this question number 10? Go through question number 10. Same share-based payment arrangements in a group structure. Yes. All right. So we run through this. A parent company P grants 30 shares to 100 employees of its subsidiary, company S, on condition that employees remain employed by S for 3 years. Assume that at the outset, at the end of years 1 and 2, it is expected that all the employees will remain employed for all the 3 years. At the end of year 3, none of the employees left. Fair value go on grant date, that is rupees 5 per share. Company S agrees to reimburse the company P over the term of the arrangement for 75% of final expense recognized by company S. What would be the accounting treatment in the books of the P and company S? All right. Yes. So in each of the years 1 to 3, subsidiary will book the expense in the P&L and the cash paid to company P and the balance as the capital contribution it has received from company P. So employee benefit expense account debit 5,000. To cash bank 1,250. To capital contribution 3,750. Yes. Yes. Manish, able to follow? Manish, please respond. In each of years 1 to 3, Company P recognizes increase in equity for instruments granted, the cash reimbursed by Company S, and the balance as investment to the capital contribution made in Company S. Journal entries: investment in Company S, cash bank 3,750 to SBP reserve 5,000. Yes, is it okay? All right, fine. Yes, all right. So that was your group share-based payment plans. Okay, fairly simple, no complications. Only thing is you should know what needs to be debited, what needs to be credited. Okay. Next, we have a concept known as graded vesting. What happens in graded vesting is that, see, normally in a share-based payment plans, you come out with options to be paid in 3 years, 5 years, etc. You have to remain employed with the company. That becomes difficult in a sector like information technology, where attrition is high, burnout is high, so they expect compensation also to be high. So in such a cases, instead of waiting for the complete 3 or 5 years that they tell to wait and pushing for uh, uh, a phased wise vesting. So instead of all options vesting at the end of 5 years, I can opt for every year 20% vesting. So what happens? Employee also comes with a satisfaction that chalo kuch to mila. I got something at least. If he leaves after say 3 years, he will at least get 20 plus 20 plus 20, 60% of what everybody has, uh, of what everybody will get who stays for the entire 5 year. Are you sure or not? Yes, are you able to follow? See, the whole point is an employee becomes bound by virtue of the vesting condition to remain in service for 5 years. That becomes very difficult for an employee. So to make it easy, what they have done is, you start vesting a little bit period on period. Yes, you start vesting a little bit period on period. So what happens is, in between, if employee decides to resign, then that employee can very well get that many options that he or she has worked for proportionately. So it vests in grades, in phases. Okay. That is known as graded vesting, a very important mechanism to ensure that employees get even some amount of benefit at least, even though they leave during the period that they are not supposed to otherwise leave in the normal course. So the following particulars in respect of stock options are available. Number of employees covered 400, options per employee 60, nominal value 100, exercise price 120. Shares offered were put in three groups. Group 1 was for 20% of shares offered with vesting period 1 year. Group 2 was for 40% of shares offered with vesting period 2 years. Group 3, 40% with with vesting period 3 years. Fair value of option per share on grant date was rupees 10 for group 1, 12.5 group 2 and 14 for group 3. Position at the end of first year you are given, at the end of second year, at the end of third year. Yes. Options not exercised were forfeited. Compute expenses to recognize in such year and show important accounts in the books of the company. Okay. So this is a graded vesting wherein every year you are having little getting vested. Yes. All right. I want you to go through this particular calculation for my satisfaction. Okay. Manish, go through this calculation. Go through this, Manish. This would have been done in the original class, but here I just want you to run through it. Okay. Manish, are you there? Yes, Manish. Yes. I'll give you another 2 minutes before we move on to the next topic. If there is any doubt, please feel free to ask. Okay, so since there is no response, I would presume that you have gone through it. Okay, and it's okay. Fine. We now come to a concept called vesting conditions. Vesting conditions. Okay. What do you mean by vesting conditions? These are the requirements that need to be fulfilled for options to get vested in the employee. Who has to fulfill these conditions? Employee has to fulfill these conditions. Why? Uh, so that he can exercise the option once the vesting period is over. So vesting conditions are of two types. One is a service condition, the other is performance condition. Your service condition is basically what we have seen till now. Employee has to remain in service for a specified number of years in the future. So 3 years, 5 years, whatever we have gone through, employee, that is all service condition. Employee has to remain in service for a specified uh, period. Okay, so that is your service condition. Then I have performance conditions. What do you mean by performance conditions? Employee has to achieve certain performance targets in order to be eligible. Achieve certain performance targets for him to be eligible. And these are put into two buckets. One is market linked performance and the other is non-market linked performance condition. Market link performance condition, if they are linked to achieving a price level or a target price or a market growth, whatever it is. And non-market linked, if they are linked to factors other than the market price. Like for example, sales, productions, earnings, etc., etc. If these are linked, then definitely you can uh, definitely you can do the accounting based on that fact. Yes. So service condition, performance condition divided into market linked, non-market linked. Market linked to a specific market target. Yes, non-market linked, linking to factors other than the market price of the entity. Example, sales, earnings, production, whatever it is. Okay. So that becomes your performance condition, non-market linked. Now, these conditions, sometimes you may have certain conditions known as non-vesting conditions. They do not affect the entitlement. Okay, so example, a waiting period after the vesting period. Okay, so that does not become uh, a condition that affects entitlement because this is triggered only after the entitlement option is over, after the entitlement period is over. Now, when you talk about accounting for non-market linked performance condition, then how will you account for it? Principles remain the same, but at the end of every year, you will see whether the entity will approach the non-market linked performance condition or not. Yes. So if that is the case, at the end of each year, the entity needs to estimate whether vesting would happen. And if yes, what could be the vesting period? Employee benefit expenses would be recorded at the end of each year based on the above estimates made at the end of each year. Fairly simple. Only thing that changes is now only thing that changes is now you need to evaluate the possibility of meeting this estimate in the future. That is your work that you need to do additionally. Okay, so now, yes, go through this question, please. Company's earnings increased by 12%, more than 20, more than 22. So this one, just do this for homework. Yes, or rather, do one thing, read it here only. If you are able to understand, well and good. Otherwise, I will help to solve this. Yeah, read this, please. Manish, any doubts? A minute. So Ankita Holdings grants 100 shares to each of its 500 employees. The employees should remain in service during the vesting period. The shares will vest at the end of first year if earnings increase by 12%. By the end of second year, if company's earnings increase by more than 20% over the 2-year period. By third year, if it earnings increase by more than 22% over the 3-year period. Fair value at the grant date is 122. In 20x1, earnings increased by 10% and 29 employees left the organization. The company expects that the shares will vest at the end of year 20x2. Company also expects that additionally 31 employees will leave the organization and 440 employees will receive their shares at the end of 20x2. At end of 20x2, company's earnings increased by 18%. Therefore, the shares did not vest. Only 29 employees left the organization during 20x2. Company believes that additional 23 employees will leave in X3 and earnings will further increase so that the performance target will be achieved in 20x3. At the end of year 20x3, only 21 employees have left. Assume that company's earnings increase to desired level and the performance target has been met. Determine the expense for each year and pass the appropriate journal entries. Very nice question because this captures performance linked, non-market linked performance condition. Non-market linked. It is linked to your earnings. It is linked to your earnings. Okay. So now, since the earnings of the entity is non-market related, it will not be considered in fair value calculation. However, the same will be considered while calculating number of shares expected to vest. So, I have at the start 500 employees. Out of 500, how many employees left? 29. Expected to leave in the next year, 31 employees. 440 will get their shares. At the end of 20x2, I started with 500. At the end of 20x2, company's earnings increased. Only 29 employees left in 20x2. So 29 plus 29, 58. And company believes that another 23 will leave. So you have 419. You have 419. And then 500, 58, another 21 employees left. So 58 plus 21, 79. Expected to leave, it won't be there because your plan itself is coming to a close. Yes, so 421 employees. Number of shares per employee, 100. Fair value at grant date, 122. So, proportion of expense to be allocated, just half, because at the end of first year, you expected to vest in the second year. At the end of second year, you expected to vest in the third year. So 2 by 3 and 3 by 3. Yes. So expenses for 20x2, 419 employees, 419 into 100 shares into 122 into 2 by 3. So that gives you 34 lakh 7,867. First year 440 into 100 into 122 into 1 by 2. So 26 lakh 84,000 out of that is first year. Second year 34 lakhs. Out of that 26 lakh is already coming from year one. So 723 is current year charge. And then last one 421 employees into 100 shares per employee into rupees 122 into 3 by 3. So 5136 minus 34 lakh 1728 333. Are we okay with this? Yes. Journal entries are straightforward. No change. Any doubts here? Yes. No doubts? All right. Fine. Okay. ACC Limited granted 10,000 share options to one of its managers. In order to get the options, the manager has to work for 3 years in the organization and reduce the cost of production by 10% over the next 3 years. Fair value of option at grant date was rupees 95. Cost reduction achieved at the end of first year 12%, end of second year 8%, not expected to vest in future. Year 3 10% achieved. How the expenses would be recorded. How the expenses would be recorded. So it is a non-market related condition. That means we have to estimate. So I have options 10,000 and fair value is 95. Proportion is 1/3 for first year, 3,16,667. In second year, proportion is 0 because it is not expected to vest in the future. So 3,16,000 will be reversed. End of the third year, you have achieved 10%. So therefore, yes, the condition to achieve 10% cost reduction was not met in year 2. You can see it was only 8%. And there was no expectation to vest this non-market condition in future as well. And hence earlier expense was reversed in year 2. Since in year 3 the non-market condition was again met, hence entire expense will be charged off to the P&L. Year 1 you thought you will meet, expense out. Year 2 you thought you will not meet, reverse. Year 3 again you met, recognize all 3 years expense. Are you okay with this? Yes. Are we okay? Any doubts? No doubts? Okay. Fine. Next, we move on to market linked performance condition. Market linked performance conditions. Non-market linked was something within the control of the entity. Cost reduction, turnover achievement, net profit maximization, P&L ratios stabilization. All these are within the control of the organization through its operations. And that is why at the end of each year, you are required to estimate whether you are in a position to meet or not meet. Like in the last question, till the last period, there was, in the second year, there was, in the first year, there was an expectation it will be met. In the second year, no expectation. So this is there for items which are under the control of the company. But market linked performance conditions are already directly priced in the fair value itself. They are directly priced in the fair value itself. The fair value is a forward looking value. I told at the beginning of the session only, it is a forward looking value. What do you mean by forward looking value? It is based on certain uh, value. It is based on certain valuation models like Black and Scholes or binomial, whatever it is. But uh, in the case of market linked, nothing is in my control. If they say when share price reaches, say 100 rupees, how do I know when it will reach 100? But when I do a fair valuation, this 100 also becomes an input for feeding the model, which will give you the fair value, which in turn will give you the fair value. Are we okay with this? Yes. Are we okay with this? So therefore, the accounting accordingly will not capture the changes to be ignored before actual vesting in the event of market linked performance condition. Okay, it will not have the charges will be ignored, the changes will be ignored because the possibility of meeting the condition is factored in the fair value itself, Are we okay with this? Yes. Yes. Any doubts? Anytime they give you, the company expects the market price to go up to so much in the next year and all, please do not fall for that. Yes, market linked condition is already priced in the fair value at the grant date. So here, this is pat, so you can do this for homework. Yes, all right. Now, Apple Limited has granted 10,000 share options to one of its directors, for which he must work for 3 years, and price of the share should increase by 20% over next 3 years. The share price has moved as per below details: 22%, 19%, 25%. At the grant date, the fair value was rupees 120. How should we recognize the transaction? The share price movement is a market-based vesting condition in this particular scenario. Even if the required market condition is not fulfilled, there is no requirement to reverse the expense previously booked. Irrespective of the outcome of the market prices, as it is already taken care in the fair value, each period an amount of 120 into 10,000 by 3 equal to 4 lakhs will be charged off to the P&L. Are we able to follow? Yes. Are we able to follow? Any doubts? Any doubts? No doubts? Okay. So that's continues this. Okay. Go through this question number 60. I mean, question number 4, slide number 60. Yes, this one. Tell me, how would you solve this? Manish. Yes. All right, fine. So an entity issues share-based plan based on below details. Employees 100, fair value 25, market condition share price to reach 30, service condition to remain in service until market condition is fulfilled, service condition 4 years. Define expenses related to such share-based payment plan subject to the below scenarios. Market condition fulfilled in year 3 or year 5. So market conditions are required to be considered while calculating the fair value. Uske baad you need not revisit it like how you do it for non-market linked conditions. Non-market linked condition, every year you have to evaluate whether it will be fulfilled or not. However, service conditions will be considered as per the vesting rights to be exercised by the employees and would be re-estimated during the vesting period. However, if the market related condition is fulfilled before it is expected, then all remaining expenses would be immediately charged off. If market conditions, if market related conditions take longer than expected period, then original expected period will be followed. Market condition fulfilled in year 3. 100 employees, 1 share into 25 fair value at grant date into 1 by 4, 625. Year 2, 625. Year 3, you fulfill the market condition. So into 25, so 1250. Year 4, nothing is left. So that will become 0. Are we okay with this? Yes. Are we okay? If this is in year 3. If this goes to year 5, then first 4 years 625 and last year it is going to be nil. It is going to be nil. Any doubt so far? Market linked performance? Yes. No doubts. Manish, सब clear है? Yes. All clear. So now we move on to certain two fresh topics, that is subsequent modification in exercise price, right? And repricing of options. Repricing of options. Subsequent modification, or what you call as repricing of options. Any idea what do we do in the event of repricing of options? Yes, Manish. Just a minute. So we start off with the repricing of options. So can the management change the exercise price? Answer is yes. And if this is modified in a manner beneficial to the employee, then we will have to calculate the incremental fair value on the modification date. That is fair value of the revised plan minus fair value of original plan on the modification date. The incremental fair value, if it is positive, where it is beneficial to the employees, consider that. In case it is negative, it will be deemed to be zero, because an option change which is adverse to employees will never be exercised. So it will be zero. So original plan will continue to be accounted for in the usual manner over the original vesting period. The modification is treated as a new plan, and the incremental fair value, if it is positive, will be spread over the remaining vesting period on a straight line basis. Okay. So if I have a modification which is adverse to employees, original plan continue as it is, new plan no effect, because incremental fair value is zero. If it is beneficial to employees, old plan will continue as it is, new plan will be recorded over the remaining vesting period. Okay, so that is all about your repricing of options. So now we come to repricing modification. Yes. Okay. Marathon Inc. issued 150 share options to each of its 1000 employees subject to service condition of 3 years. Fair value of the option given was calculated at rupees 129. Below are the details and activities relating to SBP plan. Year 1, 35 employees left, further 60 expected to leave. Share options repriced as the fair value fell to rupees 50. After the repricing, they are now worth 80. Hence, expenses expected to increase by 30. Year 2, 30 employees left and further 36 employees are expected to leave. Year 3, 39 employees left. How the modification slash re-reporting pricing will be accounted. Yes. So when did we do the repricing? At the end of year one. Yes. Total increased value is 30. So half weight each year. Total increased value due to modification is rupees 30. Yes. So year 1, 2 and 3, number of employees 1000. Original plan will continue as it is. Number of employees left 35, then another 30, so 65, and another 39, so 104. Expected to leave in the next year 60 and 36. So that gives you number of employees at year end 905, 899, 896. Shares per employee. Shares per employee 150, 150, 150. Fair value of shares at the grant date 129. Incremental fair value 3030. Are we okay with this? Yes. So original plan 905 into 150 shares into 129 into 1 by 3, 5837. Second 899, second year 899 into 150 into 129 into 2 by 3. So 1 crore 15 cumulative minus 58 lakhs. 37,250. Year 3, 896 into 150 into 129 into 3 by 3. 173, 37, 600. Then less expense recognized earlier for year 3 minus 1 lakh 57. So 57, 40, 500. 57, 40, 500. So that is your original plan. That continues to be accounted as it is. No change in that. Repricing will be treated as a separate plan. So modification expenses for sector 2 repairs, expenses for year 2, 899 employees are there into 150 into 30 incremental fair value into 1 by 2, 2022 750. Year 3, 896 into 150 shares into 30 into 3 by 3, 40 lakh 32. Out of this remove 20 lakh 22. So third year expense on account of modification is 20 lakh 9,250. So these two is the expense that will be recognized in the year 3 on account of repricing of the options as well as the original plan moving together. Are we able to follow? Yes. Are we able to follow? Manish is not there. Yes. Are we able to follow? Hope you guys are able to follow. Yes. So this is done. Next. Yes. Next. Okay. So another question on modification or repricing of options, and after that we shall take a break before we come back to review cancellation and SARS accounting. And I think that should kind of close the chapter. Okay. The following particulars in respect of stock options granted by a company are available. Employees covered 600, options per employee 60. Vesting conditions, continuous employment for 3 years, nominal value 100, vesting period 3 years, exercise 1 year. Fair value of options per share on grant date is 14. Exercise price per share is 125. Number of employees left is given 30. Expected to leave is 70. Exercise price was reduced to 120. Earlier it was 125. It became 120. Fair value of original option 13. At reduced exercise price, it is 15. Vesting date for modified option equals same as original option. Number of employees left is 35. Number of employees expected to leave is 30. End of year 3, left is 28. Entitled to exercise 500. Year number 4, 500 exercised, 7 does not exercise the option. Compute expense to be recognized in each year and also show the journal entries. Okay, so now computation of expense. Original plan, fair value is 14, amortized over 3 years, no change. So year 1 original plan, we had 600 at the beginning, 30 left, 70 expected to leave, 500. Then year 2 original plan 535, 570 minus 35, 535, expected to leave 30, so 505. Year 3 number of employees at year end 507. Yes, number of employees expected to leave not applicable. So eligible 507. Expected to vest multiplied by 60 shares per employee. So 507 into 60. 30,420. Total value of options expected to vest is 30,420 into 14. Total cumulative cost of options is 425,880. What is recognized previously is getting eliminated here. So amount to be expensed this year 143,080. Total expense for the year 173,620. Are you able to follow? Yes. So this is the old plan. Now when we look at the modified plan, modification happening in year 2. So therefore that has to be split over 2 years. So 570 minus 535, 30,505, 30,300. And then total value of options expected to vest at the end of the vesting period, 30,300 into 2. That is the repriced value into 2. Cumulative cost 30,300 for the second year, first year of modification. Second year of modification 507, 30,420 into 2, and uh, total cumulative cost 60,840. So 30,300, 30,540. All of this put together gives you your expense for the third year. Original value continues as it is. Modified plan is what undergoes a change. Are we able to follow? Yes. Are you able to follow? No doubts, I hope. So that takes care of uh, your modification or repricing of options. Repricing of options. Okay. So with that, I think we'll take a break right now. We take a break. It's almost 8:45. So we take a 15-minute break and then come back and work on cancellation and some small topics here and there. Okay. All right. Break for 10-15 minutes. Okay. Okay. Modification or repricing of options. So we now come to cancellation. So when we talk about cancellation, this is basically regarded as immediate vesting. Why immediate vesting? Because the option no longer is going to be there. When you cancel an option, the option is no longer there. So it will be treated as an accelerated vesting. It will be treated as an accelerated vesting. So it is basically equivalent to shortening the vesting period. It is basically equivalent to shortening the vesting period. Okay. So now let us look at questions that deal with cancellation. Solution signal. Yes, cancellation. Anara Fertilizers issued 2,000 share options to its 10 directors for an exercise price of 100. The directors are required to stay with the company for next 3 years. Fair value of the option estimated 130. Expected directors to vest the option is 8. During year 2, there was a crisis and management decided to cancel the scheme immediately. It was estimated further as below. Fair value at the time of cancellation was 90. Market price was 99. There was a compensation paid to directors and only 9 directors were currently in employment. At the time of cancellation, it was agreed to pay an amount of 95 rupees per option to each of the 9 directors. How would the cancellation be recorded? So initially you had 8 directors, fair value 130, number of options 2000, total options expected to vest 2000 into 8 into 130 rupees 20 lakh 80,000. Initially it was one third, so into one third 693 333. In year 2, 9 directors, 130 fair value 2000, so 23 lakh 42 by 3, so 23 lakh 40 minus 693, 16 lakh 46 667. This is your net expense for the year 2. So this is your first year, this is your second year. Now, cancellation compensation is 9 directors into 2000 options into agreed compensation of 95. So 17 lakh 10,000 rupees. This is your cancellation compensation. Out of this, you have a balance in SBP reserve right now. You have a balance, right? So you will have to meet something out of that. You will have to take something out of that. How will I calculate that? 9 directors into 2000 options per director into fair value at the date of cancellation. 90. So this is the equivalent that you are paying to the directors out of the SBP reserve. Your total compensation is 17 lakh 10. Many times the question will be, why do I have to give a cancellation compensation? See, those directors in this case, they were there with the company with the hope that they will get stock options. When you suddenly remove a stock option, because you made them wait for a stock option and you are not giving them, you have to compensate them. So that is the compensation that is calculated here at the rate of rupees 95. Now the source of this compensation cannot go directly to the P&L because the source of this compensation is the SBP reserve initially. Anything beyond SBP reserve, yes, you can take it to the P&L. So now many times the other question that arises is, I have booked 6 lakh 93, I have booked 16 lakh 46. I have a total SBP reserve of 23 lakh 40,000 and a compensation of only 17 lakh 10,000. Why should I not meet the entire compensation from the SBP reserve? And the answer is that you can utilize the SBP reserve on cancellation only based on the fair value of the stock option on the date of cancellation, because that is the worth of SBP reserve that is getting lost, that is getting carved out, that is getting removed, that is getting moved away from the stock option plan. So in this case, 9 directors into 2000 into fair value per option 90, that comes to 16 lakh 20. So I am having a balance of 90,000, which this value will hit the P&L. This value is what will hit the P&L. Now the question is, what happens to the balance? I took 23 lakh 40. Out of that, 16 lakh 20 is what I have utilized towards uh, uh, 23. I had 23 lakh 40, 16 lakh 20 utilized towards cancellation compensation. So balance 7 lakh 20, we will move it to retained earnings. Do not use entire share-based payment reserve balance, because it is not a representative of the compensation on the date of cancellation in fair value terms. It is based on fair value at the time of grant date. But today, when you are cancelling, you are basically going to, uh, today, when you are cancelling, you are basically going to pay basis the fair value on the date of cancellation. So only that amount can be utilized. Balance has to go to the P&L, even if there is balance in SBP reserve. Okay. And final SBP reserve balance goes to retainder. Okay. So that takes care of cancellation. That takes care of cancellation. Okay. Any other question on uh, cancellation? I don't think so. Yes. All right. So cancellation is quite similar to early vesting. Okay, so you can do that. All right. With that, we come to an end on stock option plans, pure stock option plans. Okay. Now we move to a second category of instruments, that is share appreciation rights, stock appreciation rights or share appreciation rights. Now, in this case, your your SBP liability. What is the difference between SBP, I mean, SARs and ESOPs? In SARs, you pay cash based on the share value. You don't pay, you don't issue your own equity shares. SARs is a preferred way of paying the employees because of multiple reasons. First one, the control does not get diluted at the promoter level or the investor level, because what you are paying is cash, you are not giving them shares. Second one, in the case of ESOPs, what happens is employee must first have the cash to buy the share, and then he can utilize that to sell or hold it. So the fundamental issue with ESOP is to encash an ESOP, the employee must first have cash with, right? So if there is no cash with the employee, then an ESOP cannot be fulfilled. And it is this void that is filled by a stock appreciation right. Apart from not diluting the stakes, what this achieves is it will hold a uh, what stock appreciation right achieves is that it will provide cash to the employee. So, for example, if the exercise price is X and your market price is say Y, then Y minus X is something that will be provided to the employee. Okay, so you will get that point, that value. Okay, or if there is no exercise price, then whatever is the fair value will be provided to you, in cash. You need not have cash with you. You need not have cash with Are we okay with this? Yes. So that is why SARs typically become a little more popular than ESOPs. Okay. But the other advantage of ESOP is you directly become an owner. Nothing can beat that when you are getting stakes in the company, right? So coming back, accounting for SARs, straightforward. Only thing, everything is same as per ESOPs. Only one big difference is that every reporting date you will have to revalue the stock appreciation, right? You will have to revalue that. Okay. So XYZ issued 10,000 SARs that vest immediately to employees on 1st April 2020 vest immediately. The SARs will be settled in cash using an option pricing model. At that date, it is estimated that the fair value of a SAR is 95. SAR can be exercised anytime up to March X3. At the end of the period on 31st March X1, it is expected that 95% of total employees will exercise the option. 92% will exercise the option at the end of next year. And finally, 89% will be vested only at the end of the third year. Fair values at the end of each period have been given below. 112, 109, 114. So fair value at the time of vesting, that is grant date, is 95. Okay. So 10,000 into 95, 9,50,000. Percentage of employees expected to satisfy the condition. So 95%, 92%, and 89%. Fair value 112, 109, 114. This is at the closing date of each reporting period. Total value 10,000 SARs into percentage of employees expected to satisfy into fair value, that is 112. So 10 lakh 64, 10 lakh 2,800 and 10 lakh 14,600. Amount already recognized previously, I would have booked 9 lakh 50, 1064 and 10 lakh 2. So 1 lakh 14, 61,200 and 11,800 is your net expense. So employee benefit expense 9 lakh 50 to SBP liability 9 lakh 50. First, when you give the introduce the SARS, then fair value movement 1 lakh 14, then 61,200, then employee share-based expenses account debit to SBP reserve, compensation expense recognized 11,800, and then SBP liability account debit to bank account 10 lakh 14,600. This figure. Okay. So that is done. Next. That is your accounting for stock appreciation rights. Are we able to follow? Yes. Are we able to follow? Yes. All right. Similar question. Minda issued 11,000 SARs that vest immediately to its employees on 1st April. The SARs will be settled in cash using an option pricing model. At that date, it is estimated that the fair value of a SAR is rupees 100. SAR can be exercised anytime until 31st March 20x3. It is expected that out of the total employees, 94% at the end of period, 91% at the end of next year will exercise this option. Finally, when these were vested, that is at the end of the third year, only 85% of the total employees exercise the option. Yes. So with that, I think we can work this out. Just holding it up for some cross check from your end. Yes. Yes. All right. So similar workings, fair value of option at each reporting date is given, percentage of employees expected to satisfy the condition is given. So total value 94% into 11,000 SARs into 132 fair value. So you get fair value at each reporting date minus what is recognized earlier, amount to be expensed in the current. Okay. So employee benefit expense account debit to SBP liability for year one opening, then year one closing, then year two, year three. Yes. And then share based payment liability. Okay. So that takes care of. All right. Fine. Next. This is interesting in the sense they have shortened the years of service. So P Limited granted 400 SARs each to 75 employees on 1st April with a fair value of 200. The terms of the award requires the employee to provide service for 4 years in order to earn the award. The fair value of each SAR at each reporting date is as follows. You are given 4 reporting dates. What would be the difference if at the end of the second year of service, T Limited modifies the terms of the award to require only 3 years of service? So first one we calculate without modifying service period. 75 employees, 210, sorry, 220, yeah, 210, 220, 215, 218. So total value of options is there. Next, proportion, since it is over 4 years, 1/4, 2/4, 3/4, and 4/4. Then expense to be recognized till end of current year. Yes. So total net expenses 1575, 1725, 1537, and 17 lakh. Now suppose they say that we will at the end of uh, what did he say? Okay. Now 75 employees expected to fulfill fair value 210, 220, 215. Total value of options this proportion 1/4, 2/3, 3/3. So that comes to 1575. Then 28 lakh 25 and 20 lakh 15, which is basically after knocking off what was previously recognized. Important changes this two-third and three-third. Earlier it was 4 years, so 1/4, 2/4, 3/4, and 4/4. But here we are changing the vesting period to 3 years. So therefore, from year two onwards, it becomes uh, accelerated vesting. So we record this and then we book the expense 15 lakh 75. This should be my bad. 15 lakh 75, 17 lakh 25, 1537 500, 1702 500. After modification 1575, 20 lakh 50,000. Are we okay with this? Yes. So SARS is done. Yes. So that is done. All right, fine. So that concludes stock appreciation rights, including acceleration of the vesting period. Yes. So now what is left is SBPs with cash alternative. Group SBPs are done. Yes. All right. Now, okay. So far, we have seen cases where employee gets either equity share or cash. Equity share ESOP, cash in the case of share appreciation rights. There was only a movement of cash. But what if there is an instrument where employee has a choice to opt for either equity or cash? The settlement would be in cash or in equities, entity's own equity shares. Then what can we do? Okay, that is something that we need to uh, understand. Okay, because going forward, let the employee make a call whether he wants cash or whether he wants. Uh, yes. So how do we do this? The following procedure would be followed. We'll run through with a question, and that question in turn should help you understand, right? So the whole point is that you are giving an option to the employee himself, not the company is not making any decisions uh, in this regard. It's the employee's call. So fair value of the shares are as follows. You have this 102, 113, 120, 132. Okay. ABC Limited gives options to its KMP to either take cash or 1,000 equivalent to 1,000 shares or 1,500 shares. The minimum service requirement is 2 years and shares being taken over must be kept for 3 years. So that is your now. How do we do this? First of all, estimate fair value of equity plan, assuming all employees opt for settlement in shares. Then estimate fair value of cash, assuming everyone estimates for cash. Equity option value will be step one, that is equity, minus step two, that is the liability, right? So now let us start by, all right. Let us start. Equity alternative 1,500 shares into 102, 1,53,000. Cash alternative 1,000 shares into 113. Grant date fair value on January 1st, 20x1. Equity option 153,000 rupees minus 1,13,000. The difference between these two, 40,000 rupees. Okay, now cash option using period end fair value. Number of options, fair value. Number of options 1,000. Fair value 120, 132. Total fair value 1,20,000, 1,32. Spread over 2 years. So that gives you 60,000 and 72,000. And equity option of 40,000 spread on straight line basis. Yes, equity option of 40,000 spread on straight line over the vesting period. That is this 40. Okay. So total expense for the period 88,000 and 92,000. Are we okay with this? Yes. Are we okay? No doubts. All right. So entry will be employee benefit expense account debit 80,000 to SBP reserve and share based payment liability account. SBP reserve. Yes. Next 31st December X2 92,000. SBP reserve 90 and then 72,000. Next, SBP liability account debit 1,32,000 to bank. Settlement in then balance in SBP reserve, move it to retained earnings. Okay, so that is about your compound instruments, SBPs with a cash alternative. Okay, so we can pull up another example to understand how this works. So Tata Industries issued share-based option to one of its KMP, which can be exercised either in cash or equity, and it has the following features. Option 1, number of cash settled shares is 74,000. Service condition 3 years. Number of equity settled shares 90,000. Service and restriction to sell 3 years and 2 years. Fair values are given with restriction for 2 years 115, fair value at grant date, etc. So 135, 138, 140 and 147. So now how do we calculate? How do we calculate? Okay, now fair value of a share with restrictive clause. With restrictive clause 150. Shares allotted 90,000. Number of shares allotted 90,000. Multiply. So fair value 1 crore 3,50,000. Fair value of a share at the grant date 135. Number of cash settled shares 74,000. Fair value is 74,000 into 135. So 80, so that comes to 99 lakh 90,000. Fair value of equity component is 1 crore 3 lakh 50 minus 99 lakh. Yes. So that is where it comes from. So fair value of equity component is 3 lakh 60,000. So you have a liability component and you have an equity component in the uh, hmm. Now, how do we recognize options into fair value? That gives you total fair value is given here, period is given, proportionate expenditure is given, and after removing that, amount to be expensed each year is also available. So 35 lakh 24,000 credit SBP reserve and SBP liability. Next, employee benefit expense 36 lakh 22, SBP reserve 120. Next, for 4091 333, SBP reserve 1 lakh 20, SBP liability 3971 333. If cash alternative is chosen, SBP liability account debit 1 crore 8 lakh 78 thousand is something that you will pass this entry if you have chosen the cash option. Once you choose the cash option, you cannot keep SBP reserve as it is. You will have to move that to retained earnings. If you choose equity option, then SBP liability will vanish, SBP reserve in will come in, and equity share capital will be recognized, subject to, of course, face value and securities premium being pending for recognition. Are we okay with this? Yes. Are we okay with this? Anybody has any doubts? Any doubts here? No doubts? Yeah. So try this question out right now. Ambani Limited grants, same like Tata Industries question, exactly the same. Only figures are different. So try this out. Let us see. Yes. Try this out. Yes. So similarly, your question at 1st January, Ambani Limited grants its CEO an option to take either a cash amount equivalent to 800 shares or 990 shares. Minimum service requirement 2 years. Condition to keep the shares for 3 years if the shares are opted. Share alternative value with restrictions 212. Grant date fair value on 1st January 213. Fair value on December 20X0X1 220 and 232 respectively. So your equity alternative 990 into the restrictive value 2,09,880. Cash alternative 800 into 213 170 400. So your equity option is 39,480. Now, number of options 800, fair value at each reporting date 220, 232, total fair value 1,76, 185, 600. Expenditure half and then full for the second year. So 88,000, then 185, 600. Then when you subtract what was booked earlier, amount to be expensed in this year 88,000 and 97, 600. Equity option of 39,480 spread over a straight line basis. So total expense 1,07,740, 1,17,340. So employee benefit expense account debit 1,07,000 to SBP reserve to SBP liability. Similar entry 1,17,340 SBP reserve SBP liability. If you opt for cash option, then share-based payment liability to bank and SBP reserve will move towards retained earnings. All right. So that is all about SBPs with cash alternatives. We have also discussed group SBPs in detail. Okay. Now, SARS we have discussed, uh, ESOPs modifications, repricing, cancellations are discussed. Performance conditions we have discussed, market link performance condition, non-market link performance condition. Then ESOP's service condition also we have already seen. I had asked to just review this graded vesting, but since we have time, I think I will only run you through the graded vesting so that it gives clarity and we can complete this. So graded vesting, the whole advantage of graded vesting is that an employee gets at least some portion of ESOPs within the vesting period. He need not wait for the entire vesting period to arise. He need not wait for the entire vesting period to come in play. Okay, so that is the advantage. Now, okay. Now, uh, the following particulars in respect of stock options, you have given number of employees, options per employee, nominal value, exercise price. Shares offered were put in three groups. Group 1, 20% with vesting period 1 year. Group 2, 40% vesting period 2 years. Group 3, 40% vesting period 3 years. So first year, you walk away with 20%. Second year, you walk away with another 40. So 20 plus 40, 60. Third year, you walk up with the final 40%. So that brings 100%. So an employee stays for 3 years, he takes 100%, leaves in 2 years, 60%, leaves after 1 year, 20%. He is also advantageous that it is flexible and he does not go empty-handed if he leaves within 3 years. Fair value of option per share on the grant date was 10 for group 1, 12.5 for group 2 and 14 for group 3. So you are having position on first year, number of employees left, expected to leave, in year 2 and year 3, employees exercising options in group 1. Year 2, employees left, expected to leave in year 3, exercising options in group 2. Position on the third year left is 28, end of last vesting period 297, exercising options is 295. Options not exercised immediately on vesting were forfeited. Compute expenses to recognize in each year and show important accounts in the books of the company. Total shares under ESOP 60. Group 1, 20% vesting, so 12 shares, vesting period 1 year. Out of this 60, 40%, so 24 shares, vesting period 2 years. Last 40%, another 24 shares with a vesting period of 3 years. So now computation of expenses for all the years. I have year 1, group 1, group 2, year 1 and 2, group 3, year 1, 2 and 3. So it will be a multiple columnar presentation that we are staring at. Okay, now year 1, number of employees 400, number of employees left 40, so 360. So 360 is there for all year ones, right? 360, 360, 360. Fair enough. Next, expected to leave in the future. For group 1, it is irrelevant because vesting period is only 1 year itself. Expected to leave in year 2 in the future. So 36 in this case. In group 2, year 2 is irrelevant. Okay, then group 3, 36 plus 34, 70. Then year 2, 30. Year 3, obviously not applicable because end of the vesting period. Okay, next. Number of employees eligible, 360. Then 360 into 12, expected to vest 4,320. Fair value per option 10, so 43,200. This is the expense that you will recognize in respect of group 1 in the first year. Next, group 2, 360, another 36 expected to leave in year 2, so 324 into 24, 7,776 into 12.5, that is the fair value, 97,200 for cumulative. So divided by 2, 48,600 will be group 2 year 1, 48,600. When we move to year 2, 325, number of employees 7,800, so 97,500 minus what is already booked 48,600, so 48,900. Next we move to group 2 is over, complete. Group 3, 360 minus 70, 290 into 24 into 40, 97,440 divided by 3, 32,480 is the cost per year that you have recognized. Next, if you look at year 2, we start off with 325, 30 expected to leave in year 3, so 295. Out of 295, now 24 shares are there per employee, so 7,080 into 40, 99,120 into 2/3, because second year is over. This is a 3-year tenured plan. So into 2 by 3, 66,080. And because it is 66,080, you subtract from that 32,480. So 33,600 becomes the cost for the second year in respect of the third group. Year 3, final employee count is 297 into 24, 7,128. 99,792 is the total. What you have already recognized is 66,080. So 33,712 is something that you would have to will have to recognize in the third year. So now when I look at total expense for year one is at uh, 43,200 plus 48,600 plus 32,480. So 124,280. Year two, 48,900 from group two, 33,600 from group three, 82,500. Year three, only group three will come, 33,712. So that is your overall expenses for years one, two, and three. So employee compensation expense also, if you want to see if anything else, journal entry. All right, next. Employee compensation account, straightforward entry debit to SPP reserve. SPP reserve is the complicated entry. By compensation account 124 280. Then of course exercising will happen. So by bank 350 employees into 12 options into 125. So that becomes 5,25,000. Then to share capital 350 into 12 into 100 420. To securities premium 350 into 12. Can I move entire SBK reserve balance to retained earnings? Answer is no, because group 2 and group 3 vesting is still pending. So to retained earnings, I will move 10 employees into 12 options into rupees 10. So 1,200. So just a minute. Yeah. Mm. That. Yes. So no moving entire balance to the uh, retained earnings, because we have groups 2 and 3 also pending. So only 1,200 will be moved, which is basically the 10 employees who did not exercise the option. Just a minute, please. Okay. Now coming to, so 81,080 will be the balance in your SPP reserve. Okay. This is basically group 2 and 3 unexercised portions which is carried forward. Now, employee compensation expense 82,500 for year 2 credited. Then what is given is 319 employees exercise the options. So 319 into 24 into 125, 957,000 exercised by bank, and then we issue shares to them. So 319 into 24 into 100, 765, 600 into 24 into 37.5, 287, 100. This is the premium calculation. 125 plus 12.5, 137 less nominal value. So that becomes your premium. So 287, 100. Now, out of 325 options, how did I, 325 employees, how did I get 325? I started off with 400, 40 left in year one, 35 left in year two. So that leaves me with 325 employees. Out of 325, 319 only exercised. So 6 employees did not exercise. So 6 into 24 into 12.5 is what I am moving to retained earnings. Balance will be kept as it is because there is a third group that is pending for vesting and exercising. Here, I will book the third year's expense 33,712 only in respect of group 3. 297 employees were there, out of which 295 employees exercised the option, 8,85,000. So that one we will split into share capital and securities premium. So share capital will be 7 lakh 8, premium will be 276 120. Retained earnings will be 2 employees into 24 into 14, 672. So that closes out your SBP reserve account in totality. So then what will be left is no SBP reserve. All expenses are booked. All SBP reserves are either moved to equity and premium or they have been moved to retained earnings. So this is the concept of graded vesting, where every year a small portion of the overall employee stock option pool gets vested. Okay. So with that, I think it kind of concludes your stock option plans. And uh, we also have a, let me see, this is entirely stock options. Yes. Some questions I have not done because it's a repetition, but if you can go through it, it will be helpful for you. Uh, there is one question on accelerated vesting. I didn't do that specifically separately because we have done cancellation and we saw one accelerated vesting also. So it's based on similar concept. So you can do that by yourself. Okay. All right. So repricing is something that we have already done. So that you can go through this for your homework. Okay. Next one is this is done. This is done. Okay. Now, okay. So now that this part is done, if we move on to the next one, uh, when we talk about share-based payments, it specifically excludes transactions with shareholders in their capacity as shareholders. So suppose an employee is also owning shares of the company that he has acquired from the open market, then any transaction with that employee is excluded from the purview of Ind AS 102. Share-based payments to owners in consideration of acquisition of control over business. That is purchase consideration. That is excluded from Ind AS 102. That goes and sits in your Ind AS 103. That is business combinations. Buying or selling non-financial items which can be net settled. That is also not covered under Ind AS 102. That is outside the purview of Ind AS 102. So that kind of broadly covers the uh, discussion that we had on Ind AS on share-based payments. The next one, what we have other than employees, though we just briefly touched, since we have time, I'm just recap, re, uh, recapping whatever we have discussed. So, other than employees, for goods and services, when do I recognize? In the case of goods, the timing will be when control of goods is obtained. Servicing, as and when we receive the services, when services are entered, the stock option plan is the share based payment is recognized. At what value? So fair value of goods or services received, generally presumed to be available. This is the first preference. If this is not possible, then the fair value of shares or options issued. Basically, a stock option, a share based payment is a barter transaction where the entity issues its own shares and gets the uh, services. So in this case, provisions of 102 will apply, and we can take the fair value of goods, services, or property, plant, equipment received. So this is the first option. In case the barter does not involve the entity issuing its own shares, then general principles of barter under Ind AS 13, Ind AS 16, 38, and 40 will apply. Okay. So if you have a barter, like if I, for example, if I give up one asset to acquire another asset, then principles of Ind AS 16 will apply. But if I get an asset for payment of in with payment being made in equity, then Ind AS 102 will apply and not Ind AS 16. So in the case of, so that is about regular barter transactions. Okay. Now coming to what we all discussed today. We started off with ESOPs, the major item of today's discussion, and in this standard. So we have covered equity settled plans, that is ESOPs. We have covered cash settled plans, that is SARS. In equity settled plans, we have seen accounting where you have a vesting condition being service period. Then we have seen a performance condition being non-market linked, where you estimate at the end of each reporting period whether you will fulfill and accordingly take the vesting period. Market link condition do not estimate because it is priced in the fair value itself. No intrinsic value to be considered because we are doing a forward-looking estimation based on fair value at the grant date. Then we also went into stock appreciation rights that deals with cash settlement. You do a fair valuation at each reporting date because it is a liability and it must be presented at fair value. And finally, we also saw uh, a combination of the two. We also saw combination of the two, wherein there is a cash plan with an equity alternative. So that is a compound instrument, how to do the accounting, where employee has the option to go for either receiving cash or receiving shares. And then finally, we also saw group share-based payments, a concept which was not there under the erstwhile guidance note, where a parent will issue its shares to employees of the subsidiary. It will be treated as an invest. It will, when parent is issuing its own shares to the services received by the subsidiary. In that case, uh, how do we do the accounting? And the other way, where subsidiary issues its own shares, where a subsidiary issues its own shares to the parent's employees. So where subsidiary issues, employee will book employee benefit expenses and subsidiary will show it as if it's a dividend paid out. In the case of parent issuing to subsidiaries employees, subsidiary will book employee benefit expenses and parent will record it as if an investment is made in the subsidiary, as if an investment is made in the subsidiary. Okay, so with that, I think we are drawing to a close. If there is anything, then please do let me know. Yes, so that kind of closes out the topic in totality. I don't have anything else to add. So that's it from my side. Thanks, everyone. Thank you. We can end the session. Can end the session.
Recording stopped.
Yes, done. Thank you.